Hey, everybody. Thanks for joining us today. It's myself, Andrew Whalen, and our portfolio manager, Carl. We're going to go over the second quarter of 2021, give a little economic update. I know we get to talk during our quarterly meetings, and we try to keep it at a bird's eye level, but today we're going to go a little bit more granular, look at a few charts that happened during the second quarter, go over some information that we thought was informative or will be informative to our clients, and go over just basically a general update on what's happening, not only economically, but also in the markets. So without further ado, we're just going to get this started. What do you think, Carl?
Sounds great. We have a lot to talk about, but we'll try to keep it brief.
Sounds perfect. So like I said, we're going to go over some market data today, look at different charts and tables that are highlighting some of the performance of the stock market and individual asset classes just over this latest quarter. But before we begin in that, we do have to give some important disclosure information. This keeps the regulators as well as the attorneys happy. So I'm going to leave this up here for about 5 or 6 seconds, just so if anyone is interested, you could actually read it.
You could pause and then read it.
You're right. You could pause and then read it. So now that we're through that, let's get into the fun stuff. So I'm going to kick it right off to you, Carl. So this just kind of goes over key stock market index performances for that second quarter. What's going on right here?
Well, technology stocks outperformed in this quarter, and it was mostly because of they sold off in the first quarter quite a bit, but people were pretty scared about inflation at a few points in the first quarter, and then again at the second quarter, and then after the Fed meeting in June, where they communicated a slower rate of raising interest rates and just didn't want to talk yet about slowing bond purchases. People became less fearful about inflation going up, so all the most interest rate sensitive assets really did well. So stocks in general came back a little bit more in the last couple of weeks of June, and large technology companies tended to outperform. Now,
yeah, and that's what this chart's basically indicating, right? It shows the NASDAQ, which is predominantly technology stocks, that was up almost 10% for the quarter. The S&P 500 was up about 8.5%, and the Dow Jones right around 5%. But you're right. We had that inflation scare at the end of the first quarter, going into the second quarter, and mostly in May areas where we saw that sell off. And then the Fed came out and kind of stabilized things. And from that meeting forward to the end of the quarter, it really kind of just skyrocketed.
But the overall takeaway was that this was a better quarter than average for everything, really. Even international indexes did well. You can see emerging markets, international outside of the United States, also a pretty solid quarter. In general, for equities, you tend to expect most quarters to average 2 to 3% would be average, but this was a big above average quarter.
Yeah,
we've had a string of those, as you would expect, coming out of a recession and bear market, as we've had over the last year. But this was a stronger one than average. I mean, if every quarter was like this, it would be, a 20 to 30% year in equities, which you don't have very often.
Right. Yeah. Even now coming out of a recession, yes, but after the strong year that we saw last year, it is still surprising, and we made note of that in that quarterly commentary. So this kind of gets back to sector performance in the quarter, right? What sectors really drove the markets? And what was really surprising to me, and maybe it's just based off of the realization that maybe inflation or the Fed wasn't going to move immediately, was the huge outperformance in real estate during that second quarter.
Right. Well, real estate, the expectations have been elevated since, a lot of it's tied to reopening. A lot of it, like particularly in retail and office, is strongly tied to reopening. But it's also very rate sensitive because REITs tend to borrow a lot, and any company that borrows a lot but doesn't necessarily grow that much, but people view it as something really stable, it's going to be very interest rate sensitive. So I think for those were the reasons why real estate had such a great quarter. You can see like technology and communication services also were at the top.
Yeah, phenomenal. And one,
Utilities kind of
yeah, that's
backed
one
off
thing to
because it
point
had
out.
such a strong quarter in the first quarter. But energy also did really well because, with the world normalizing, energy commodities just got back to more normal prices.
Right. Risk on, technology on, risk on, utilities off, essentially, right?
Right.
Yeah. So then on this next slide, we kind of go over the trailing periods of just the asset class performance. Now, this goes back over 10, all the way back over 10 years, all the way up to year to date. What's something really interesting about this, Carl? You and I talked about just diversification, right? So if we look here, the S&P 500 has averaged just under 15% over the last 10 years. Now, it's been a phenomenal last 10 years. But what's interesting to me is, just growth in general has been the big outperformer, specifically in the United States.
Right. I mean, that's been because of the big boom in smartphones, the internet, online advertising. It's been a huge thing, and the leading companies there in the whole world and really serving the whole world are in the United States. So that's been the biggest part of that, because you can see, typically smaller companies perform well or outperform large ones over a long period of time. And you can see that US small there is trailing the S&P 500 by a pretty significant margin.
Look at commodities over the last 10 years, huh? That's something.
Right. Well, 10 to 15 years ago, commodity prices went up, and then people responded to that.
Right.
People figured out how to drill for oil and gas more efficiently, and there wasn't the inflation that people were expecting coming out of the financial crisis either. So commodities have had a real weak last 10 years.
What I would point out in that bottom right-hand corner, if you can see my mouse when I do this, is the ag. So that is basically the Barclays ag, I believe, right? Yeah, Barclays US aggregate. So it's the bond index. Not much difference between that 5 and 10 year. And I think that's indicative of kind of what's been happening with interest rates, right?
Right. Well, bonds can move around a lot over a short period of time, but the longer the period of time you look at, it tends to be more what you see is what you get in terms of the yield on them. And that's particularly true with shorter term bonds, even intermediate, particularly high yield in corporate and municipals. Now, if over a long period of time you have changes in the overall level of interest rates, that can affect the value of bonds. And that's actually helped them a lot over the last 10 plus years, because rates have declined probably about 250 basis points or so.
Yeah.
So, I mean, like 10 years ago, like the 30-year treasury used to be around 4, and now it's 2.
Right. Yeah. And I think a big thing here is, when you're building a portfolio, you don't want to be overly allocated in one area for too long, or just think that the gravy train is going to keep on running without crashing off the tracks, right? I mean, we're in this business for a very long time that have the ability to affect individuals' lives and generational lives. Following a fad of commodities up 31% year to date may not be the best thing 10 years later. And I think that's what we're in the business for.
Right. But also the general philosophy behind diversified portfolios is that sometimes certain asset classes do well and other times others do well. And if you have some broad exposure or the flexibility to be in different areas at different times, you can improve your returns and your overall risk adjusted results. And this slide, going back further quarter by quarter, illustrates that even more. And these kinds of diagrams are some of my favorite, because you get to see everything over a period of time, but it shows you that every asset class has its day, has its sunny day and rainy day.
Right. Yeah, let's look here. This would be COVID right here, this column. where you essentially see on 331.20, US Treasuries clearly outperformed. The ag was up, and you look at US growth down 14, S&P down, call it 20. It's really interesting to look at it quarter by quarter as well. So for this last quarter, the best performing asset class was commodities, closely followed by US growth.
Right. And so, yeah, I mean, there are periods of time where, bonds and US Treasuries really outperform when people are afraid. There's a lot of volatility. People don't want to take risk. And then there are other times when things are really growing that the riskier asset classes outperform.
Right.
And that's kind of what you see here.
So what's this chart telling us?
It's been a great last year for just about all kinds of portfolios, no matter what they were. But the more exposed you were to equities, the better you've done.
Right. So this basically shows the different models. So the purple line or the green line would be just the S&P 500. So if you put your money in the S&P 500 at the end of June, end of June last year, you'd be up about 40%. If you were a little bit less aggressive and you went into an 80-20 model, that's 32%, which is also surprising because you're only taking 20% off the table, but only have an 8 basis point underperformance of the S&P. That's, it's pretty interesting. And then 50-50 up about 19%. And then a conservative model, which is 20-80, up about 7%, all still really strong year-over-year rates of return, specifically for someone in a conservative model. That's really interesting. Now, this is one you and I talked about. So that I'm a huge fan and obviously a student of Warren Buffett. I think The Intelligent Investor was one of the first books that I read with regards to investing. So that took me about 3 months probably to plow through that at the age of 11 or 12. But he has this theory on total market capitalization to GDP. So market cap, the total size of the S&P 500 compared to the US GDP. And what this chart shows is that, it's almost, what is that? 2 times the average. So the average is the market capitalization should be an average of about 100% of what GDP is. Today, it's about double that. Now, we're not saying that means anything. It could mean something, and only obviously time will tell, Carl. But this is one of many reasons why, at least in our growth portfolio, when we see these strong quarters, when we see these strong years, where we start to proactively look at the portfolio and start to take some of those chips off the table, not to use a Vegas term, so that we start playing maybe a little bit with the house's money and conserve the portfolio for any potential drawdowns. You can kind of see, as this chart indicates, anytime it really peaks above that average, there tends to be some form of a sell-off. And we just really haven't seen one, since COVID.
Right. So this is a really high level indicator. I mean, just what are the value of equities like relative to GDP? There are a lot of things that go into that and can affect that. But yeah, it's definitely very elevated right now, and it's continuing to go up, but it looks like it could be cresting a little bit there.
Right. And with the most recent GDP numbers, I think we're expected 9. We only got 6. It's just going to widen that gap even further if the equity markets continue to rally.
Right. So some people talk about this and they say, well, this is okay because the economy is more service oriented now, and companies are more asset light. We have more technology companies, not as much of an industrial economy. There's a lot of international sales in there for all of those. So some people use those things to say that some of this is okay, and I think that's that's true. But definitely, I mean, as we've talked about and also discussed in our quarterly commentary, the valuations are elevated right now. I mean, they're not as high as they were in 2000, but they're definitely significantly above average.
Sure. Yeah, so now let's get into bonds and interest rates. This really kind of not only affects the growth portfolio, but definitely the conservative portfolio. What's going on in the bond market? What's going on with interest rates? What's the Fed going to do with the federal funds rate? Or when are they going to start tapering? So what we're going to look at next is just a few charts that kind of go over and summarize some of the moves in the fixed income markets. So this is just basically an interest rate summary where it looks at the yield curve. So that can be anywhere from T-bills all the way up to, or the federal funds rate all the way up to, a 30-year treasury. Carl, talk to me about the yield curve. Talk to me about, what typically may happen historically when the Fed starts raising rates, the shape of yield curve. Get into the meaning of some of those things and kind of just what you extrapolate from this interest rate summary.
Sure. So the yield curve is really, the different yields on treasuries of different maturities. And the Federal Reserve, they can't control the longer term yields. Those are really just determined by the market. They can get in there and buy more bonds to affect those a little bit, but they can't affect them directly. They're really affected more by what's happening globally, what other countries are doing. Do they want to buy US treasuries? If our yields are higher than theirs, then they do a certain amount of that. But the federal funds rate is just a short-term rate. And so they can affect that pretty directly. Right. And right now it's floating between 0 and 0.25. So that's why the very bottom left-hand part of the diagram shows that the curve is down there. And so as you go out in time, you can look at the shape of that and the slope of that and see that bonds going out a year, like T-bills going out a year or so, 2 years, they have higher yields on them because it's expected that over the next couple of years there will be some rate increases. Right. And so that's priced in, and so a certain amount of that treasury market pricing implies what the Fed will end up doing over time. But when you get out beyond 5 years or so, those treasuries don't react as much. That's really based on the level of inflation and international capital flows, all of that. So typically what happens early on in the business cycle, when you've had a recession, the Fed responds by lowering the interest rates to wherever they think they need to go. And, they've been 0 the last couple of times. And that's where they are right now. As they ultimately end up raising interest rates here, what will happen is
the left side goes up, right?
The left side goes up. And so the question always is, does the right side go up also, or does the right side come down? Well, that depends on inflation and what people expect in terms of economic growth.
Well, we essentially in that last rate hike cycle, we did see not only a flattening of the yield curve, basically the long end of the yield curve stayed relatively where it was as the Fed started to march interest rates higher. And then eventually what you just said, that longer end of the yield curve actually dipped below where the short end of the yield curve was. Call it, I think they call it the yield curve inversion. Correct me if I'm wrong.
Right. That's usually what happens over the course of a business cycle because the longer term rates don't change that much. And then if it so happens that the Fed gets ahead of where people think rates should be, then the yield curve can start flattening as they raise the short rates, and then the longer rates stay where they are or actually come down. And once you get into that flat yield curve environment for a year to 18 months, the bank lending starts slowing down, and you're at the end of a business cycle, and so things really start reacting. The stock market starts reacting to that, and even the bond market, the riskier parts of the bond market start reacting to that too.
And that's kind of where we're at over the next 6 to 12 months. What is the Fed going to do with the federal funds rate? And I think we do have a chart on Fed policy coming up, so I'll save that for a little bit later. But it's almost textbook, right? Just textbook environment of business cycles. If you extrapolate the things that you can't control, like COVID, it would be textbook business cycle monitoring, and that I just found that really interesting. So we're going to shift over now and kind of just view some high level things on some macroeconomic data. And this is the leading indicator data and trends. And I know you and I talked about this. So on the left hand side, it kind of looks at different indicators that are monitored based off of the health of the economy. And essentially, the easiest way to put this, but I'll let Carl kind of get a little bit more granular into it, is you want to see more green. The more green you see, the better or the healthier environment that we're in, and potentially more beneficial for overall investing, depending on what you're investing in. But the only thing I wanted to point out is from Q2 2020 or Q3 2020. You can see a decent amount of red in this chart. Now, flash forward a year later, you've seen even improvements from Q1, a lot more green in this chart than what we saw before. And Carl, I'll kind of let you explain that a little bit in more detail.
Right. So, yeah. So manufacturing and business activity has been pretty strong recently coming out of the pandemic, and that's where the green is, as has been housing starts and building permits and retail sales as life starts to get back to normal. But right, I mean, for everything that happened, I mean, COVID was, the pandemic was really the catalyst for the end of the last business cycle. But we were close to it anyway, because if you go up here to the top line, one of the things that people like to watch is the spread between yields and shorter term treasuries versus longer term. So the difference between the yield on the 10-year treasury and the 2-year, it's one way of looking at the steepness or flatness of the yield curve. And it got very flat after the Fed started raising rates back in 2018 and 19. And we had our year plus period where the yield curve was pretty flat right in there.
Yeah, right up in
and the unemployment rate was pretty low, below 4% also. And typically what you see, after you get out of a recession and rates have been lowered and we've had all the stimulus that we've had, is the yield curve steepens again, and that's kind of foreshadowing stronger economic growth. And that's what we had in the first quarter here. But then it often kind of flattens out a little bit after that. And that's what we've seen in the second quarter. Right. And if you go back here to the last business cycle, you see a similar pattern, like in 2008 and 9, the yield curve steepened where, the 10-2 spread went up to 2.7. And then you had a period where it flattened again a little bit. And then in 2013, they started reducing the bond purchases, the taper tantrum, if people remember that. So it's possible something like that could happen again in a certain amount of time if, the talking about tapering actually, becomes tapering and materializing.
Sure. Let's talk about trade balance, Carl.
All right. So these are good, like really long-term charts to look at. There's a lot to say about all this, and maybe we'll get into it more in a future podcast. But the main thing is that, every recession, global trade slows down a certain amount. It slowed down a good amount with the pandemic because, people just weren't moving around and didn't want to ship things around as much, but it's come back in a pretty strong way lately. Particularly with China, since there's so much electronics stuff that gets manufactured over there. Europe has been kind of weak recently since, they've been having more virus spread, and people have been talking about, different countries shutting down and things like that. So, but generally over a very long period of time, the trade balance, it has to be somewhat negative because there are commodities that are priced in dollars, and then there are a lot of countries in the world that issue dollar denominated debt. So just for stability of the world, the United States kind of has to run trade deficits to get dollars out into the world. And that's something that goes back 50 years to Bretton Woods and getting off of the gold standard.
Right.
So you can kind of see that here. And then,
And do you
we
think,
tend to, coming out of recessions, we tend to be a little more leading edge with stimulus and more forceful versus other countries. So it's not surprising that, early on in the business cycle, like we tend to, our trade balance tends to get negative pretty quickly.
well, I think we learned our lesson from '08, larger amounts and faster. What I would point out here is on that chart on the right, it does look like the imports of goods has basically reached where we were prior to COVID, but the exporting of goods and services outside of the US hasn't even reached parity to where we were prior to COVID. And that may be a reflection of vaccine rollouts. That may be a reflection of how open the world economies are. And people have to really think about that because a large majority of publicly traded companies in the United States have international exposure. And
Right. We're a little more vaccinated and exported, but
right.
airplanes are a big export of ours as well. And air travel has not come back totally.
On a global scale. Yeah, absolutely. So yeah, that's just something interesting to point out. Now, here's where we talk about housing probably a couple times a week, right? And it's nothing that we're choosing to talk about. It just seems the hot commodity of at least the last quarter. So kind of this looks at mortgage rates and originations on the left hand side, where you can see the 30-year mortgage on the left hand side as of the end of the second quarter was around 288. I think it's a little bit higher than that now, even though it may have just come down just this last week. And then typically they're inversely related, right? So the higher the mortgage rates are, the less mortgage originations there are. And you can see that on the chart. So on the top left-hand corner, as that chart slopes from left to right, from maybe 4.8 in 2000 and what is that, 19 at the peak, all the way down to 288. You've also seen an uptick in originations, and I believe the origination changes also include refinancing because that's considered a new mortgage. But what I would point out is if you look at the bottom left-hand corner here of this chart, you're starting to see housing starts tick up, but most recently in this last quarter, building permits slowed down as well as U.S. single-family houses sold. And that may be, at least in part, to the short-term move in rates that we got prior to this most recent downslide. So housing's a big talking point at our firm, just because it seems like everybody wants to capitalize on the profit in their homes. But it's what we try to tell clients is you shouldn't look at your primary residence as an investment. Carl, you want to add anything on the U.S. housing market data, even though it's kind of on fire?
Right. Well, it's been slowing down a little bit because there was just a lot of activity related to people working from home and then looking to move to different places that were maybe lower cost of living or vacation destinations.
Right.
And I think by now, a lot of that activity, as things are gradually getting more back to normal, it seems like a lot of that activity is probably leaving the housing market.
Yeah, it definitely seems that way, right? If you just look at the 3-month trend, you can see housing starts are down 475. You can see building permits are down 9%, and you can see single family houses sold are down 6.5%. We were just talking to a client yesterday or the day before, where they've been watching the Boise market, and they asked us on advice of I think they sold their house and they are renting for like about $1,000 a month right now, which is a steal. And they're thinking about moving to Boise, and they wanted our opinion. And what do? We looked up the average price change year over year for Boise, Idaho. And what was it, Carl?
I think it was 40%. That's, probably 10 years worth of returns there in 1 year in the housing market.
Yeah, you may not want to be a buyer if the house that you're looking at is at 40% in a year.
Yeah, I mean, I saw an interview on TV with someone who a city councilman in Ketchum, Idaho, near Sun Valley,
Yeah, right.
where the houses are so expensive he can't afford one, and he has to figure out how to rent from like family and friends, and that's an example of
Over exuberance.
vacation destination housing going crazy. And I looked at it. It's crazy. The houses are $1,000 a square foot there.
Wow.
And it's a ski resort, but
Yeah,
it's
well,
in Idaho,
Sun Valley,
nevertheless.
they drink with their pinkies up out there. So,
I mean,
maybe
that's like Santa Monica prices in Idaho.
It is right, but no beach, right?
Right. So it feels like there are some crazy things going on in the housing market, and it's probably more likely than not to normalize over the next couple of years.
I agree. Not much on the US dollar. I mean, if you have anything to say on this, I know we pulled this up, but it just continues to strengthen.
Yeah, well, we've got stronger growth from our companies, our large technology companies in particular, and we've got higher yields on our treasuries than other developed countries have on their sovereign bonds. So, if you are an investor in Europe and, or Japan, and you're looking for safety and yield, you're going to look to the United States.
Yeah, of course.
And so when those people get interested in buying investments over here, they have to buy dollars first, and so that makes the dollar strengthen.
Yeah, chasing the best performing horse, right? I mean, that's kind of what it is. If you want to buy a horse in the US, you got to get US dollars first.
Right. Or if you're somewhere else and maybe happen to have to buy oil, and oil price has been going up too, you have to buy it in many places. You have to buy dollars first before you buy oil. So that's probably another, like, commodity prices coming back is also probably putting some strain under the dollar.
Yeah. Now, this is kind of, what we wanted to show. The next few charts were kind of the charts of the quarter. And I'll start off by talking about inflation, because that was the big buzzword. We spent probably 2 or 3 weeks looking at inflation at the, beginning of, I would say maybe the beginning of May, or at beginning of April, all the way through May. About 3 weeks, we really studied inflation, because the thesis on where we think inflation is going to be trending over the next 12 months really dictates kind of where we need to be investing dollars. In a high inflationary environment, you don't really want a lot of tech exposure that's high growth oriented. In a high inflationary environment, you don't really want to own long dated bonds. So we came to the thesis that yes, it is. And I would agree with, what the majority of people are saying, even though they didn't say this about, at the time, they were all really fearful of inflation. That's what caused the market to sell off in May, is that it is here, but it's really only because you can't shut down factories or anything within the supply chain and expect it to get back to normal right away, on top of pumping, trillions of dollars into people's pockets and expect them not to spend it. So I think that once the stimulus does kind of start to dry up, once employment starts to normalize a little bit, we'll see normalized rates of inflation over the next, let's say, 12 to 18 months. But this does show that, inflation's running a little hot right now.
Right. Well, it doesn't really surprise me, because a year ago, oil was down, was negative briefly,
right?
And it was in that $20 to $30 a barrel range, and now it's back up to 70.
And on top of that, though, Carl, on top of that, so Janelle in our office said that she went to a gas station here in town, and they were out of gas. They're not out of gas because there's no gas. They're out of gas because there's not enough workers to drive the trucks to deliver the gas. Right. So that's a supply chain disruption that's causing price movements. And this is a real life example of someone just in our office that's seen it. And I'm sure some people, at least here in Las Vegas, may have seen that as well at local stations.
Right. That's interesting. So we wrote about inflation in June, and kind of summarized what we thought about all of this. And there are some large macroeconomic forces here that you can't change, like the amount of debt in the world, the demographics in developed countries. But what we did in April and May was we looked at every example we could find of inflation, and a lot of them seemed crazy, like lumber going up so much. It's
Right.
come all the way back down since then.
I think it's actually below.
So, and used cars, and every example of inflation that we looked at, it seemed like it was related to supply chain disruptions or consumer psychology changes that had happened over the last year as a result of the pandemic. So that's why we got some conviction around believing that inflation is probably not something that's going to be going on and feeding on itself for years, but it's probably only something that we'll see for a few quarters as things get back to normal. And a lot of it is really energy commodity prices getting back to normal.
I completely agree.
I mean, because that's in terms of overall value, that's the largest thing.
Well, I mean, and this is the next sample, right? I mean, typically safe havens to combat at least US inflation haven't really been performing that well. And that's what this shows, right? So gold prices have basically done nothing for 2021, despite seeing 5.39% inflation. And the exchange rates on, our some of our closest allies in Europe and in Canada haven't peaked or really, swallowed the burden of that inflation, which tells me that it's not something here that's going to stay.
Right. I mean, people can say whatever they want on TV or on the radio, but where people are actually betting large amounts of real money, the things that you would see reacting in financial markets to big inflation expectations are actually going in the opposite direction.
Exactly right. Now, here we can't talk about the second quarter, Carl, without talking about crypto, right? So in the second quarter, after a monstrous run in the first quarter, you can see in the top right-hand corner, crypto assets basically crashed. They came back to earth is what the title said. I think we went from about 65,000 down to about 29,000 on Bitcoin. Ethereum went from about 4,000 down to about 1,700. I don't follow Dogecoin or Cardano, but Dogecoin is the famed meme cryptocurrency that is really pushed out there by Elon Musk. And I think that high of 68 cents was the night that Elon was on Saturday Night Live.
The day before he was on.
The day before. Okay. Even worse. Even worse. So Bitcoin is starting to come back. I think it's, close to 40,000. But this is just something, not talking investment advice here, but this is just something that definitely does affect risk assets that we did potentially see a little bit of bleed over in the at least volatility in certain names in the stock market. So they're starting to become a little bit more connected, regardless if we want them to or not, would be my 2 cents.
Right. I mean, this has been, like many corrections that cryptocurrencies have had, and actually it's been a relatively mild one with Bitcoin only going down 50%. I mean, it's gone down 80 to 90% before.
Right. Well, hey, I just wanted to show that. I know I couldn't say anything about this last quarter without, covering the crash in crypto. And we'll see, we've got 5 months left till the end of the year. So we'll see how things shake out. But despite that, what's really interesting is I think still Ethereum is up like 200% for the year, even after being down 50%. So
right. And I think Bitcoin is up a certain amount too, even though it's been in correction mode recently.
Yeah, nothing crazy like 60 or something like it was earlier, but yeah. This just goes, talk about the housing market. So when you're thinking about making a purchase of a new property, I gave the example to the client the other day of, if I told you a stock was up 45 or 60%, in the last year and I want to buy it, I've got to come to you with some pretty good reasons on why that's going to hold that price or continue to grind higher. And this gets back to just investing in general. This one, we're just talking about housing, where you've seen these massive runs fueled by low interest rates and an overabundance of success in the stock market that's allowed for a little bit more of leverage or to be able to pull assets to purchase more hard assets, and huge investor enthusiasm around, not always flipping, but definitely in the rental market, where you're seeing some of these big institutions come in, purchase a decent amount of housing, and then convert them into, bond-like income streams. So, just be cautious is all I would say. You look at the existing home sales, looks like they peaked, right around here. And then you look at, the housing price index, 331, I think that's an all-time high. If I was showing you this as a stock chart and telling you to buy this stock right here, looking at it historically, you would probably question my authority to make those kinds of decisions. But some reason when it comes to housing, people kind of tend to toss that to the side. So we're just telling people to be a little bit more cautious.
Right. Housing is a slower moving asset class than anything in financial markets also. So you have to keep that in mind. Whenever the price starts going up and going up at a faster rate, that's not normal in the long-term scheme of everything.
All right, Carl. So let's summarize the second quarter in a sentence. I'll give you the floor.
Well, it was a great, mostly calm quarter. We had some inflation fears that were probably not real well founded, and now we're going into the second half of the year, and expectations are high, and so we're going to see corporate earnings and how good they are, and they've been very strong so far, but the expectations were just as high and maybe a little too high in some cases.
Yeah, I completely agree. A little bit of volatility around what the Fed's going to do. I think that, technology will continue to lead the way like they did in the second quarter, as long as, interest rates normalize or they stay normalized. But all in all, it was a home run quarter. And like what you said, which I'm going to quote you on it, if we had any quarter like this last quarter, we'd happily take it to the bank. And I'm going to leave everybody with that. So, hey, thank you, Carl. I appreciate the time. I hope everybody enjoyed it. If you have any questions, comment here on the video or send us a message at waylandfinancial.com. Thanks, everybody. Have a great day.
All opinions expressed by Andrew Wayland, employees at Wayland Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Wayland Financial. Wayland Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Wayland Financial may maintain positions in the securities discussed in this podcast.